Welcome to the Mortgage Rate Weekly Market Update for the week of November 7th, 2016. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week, mortgage rates finally were able to stop moving higher. They were able to stabilize. If you take a look at the bond chart on the screen, you can see mortgage bonds have been selling off since late September. Did a head fake in the middle of October like they might recover, but we knew that was a head fake. We did recommend locking then. They did reverse and continue selling off. But fortunately, last week we were able to find a bottom there with that blue line. That was the 200-day moving average. Mortgage bonds have been playing around there. And it looks like on Friday we're able to bounce higher off of that. Still below ceiling resistance, which you can see there with the red line. But we were able to bounce off the 200-day moving average. So with that in mind, we're going to recommend carefully floating your mortgage rate to start the week to make sure it can recover and rebound the bond higher. If it can break through that ceiling of resistance, that would be great news. We can see mortgage interest rates move lower, and you can take advantage of that. Now, if they go back and retest that 200-day moving average and break below that, that would be bad news. We would quickly switch to a locking stance. So just please stay tuned. But right now, you can carefully float your mortgage rate to start the week. Now, if we dig into the economic news, big report released last Friday. It was the October 2016 jobs report. It showed 161,000 jobs were created. Now, that was below expectations for what they were looking for, and it was down from the previous month. And if we look at the trend, new job creations for 2016, the average has been 181,000 jobs created per month. That's the average. If we go back to last year, 2015, average was 229,000 jobs created each month. So average job creation has dropped down in 2016 compared to 2015. Now the unemployment rate did tick down slightly from 5% down to 4.9%. And that's almost no change in the unemployment rate since August 2015. It's been hovering around that 4.9%. But the 0.1% tick down was actually not for a good reason. It ticked down 0.1% because 195,000 people actually left the workforce. We're no longer counting the number. So it wasn't people going back to work that dropped. It was people leaving the workforce. So that's not good news in itself there. Then we saw the Fed's favorite measure of inflation was released last week. That's the personal consumption expenditure, the PCE. It showed inflation was very tame. It was up 1.2% year over year. And if we look at the core PCE, which strips out energy and food prices in that inflation, it was actually flat. So not much inflation going on. That's bond-friendly news. That means that's good for mortgage rates. Then we saw weak initial jobless claims come out on Thursday. Now they did move up 7,000 claims to 265,000 claims for the week. And that was, even though it's a jump up, that's still the 87th consecutive week of jobless claims below 300,000. So still, even though the number moved up, still a good number, still below 300,000. So it's still a good sign for the job market. Now in housing news, CoreLogic released their home price index for September 2016. It showed the national home price increase 1.1% from August to September. And the year-over-year home price increase was 6.3% nationally when you take the average. So that's great news on home price appreciation on the average. If we dig into the local home price appreciation in Delaware, we were up 0.7% from August to September, and we're up 1.4% year over year. So we're lagging behind the national average. The good news is next year looks like it's predicted to go up at least 3.8 to 4%. So that's some good news there on the local front. And then FHA made an announcement. They updated their condo approval process with mortgagee letter released October 26, 2016. Current guidelines, in order to approve a condo complex for FHA financing, it must be owner-occupied 50% of the units or more. So if more investors own those units, and it's less than 50% owner-occupied, it does not qualify for FHA financing. Well, they reduced that number from 50 to 35% if that condo unit can meet some other requirements. So could possibly drop from 50 to 35%. That's big news. That means some condos that don't qualify now, if they resubmit their application, they could qualify if they meet the guidelines. The new guidelines are applications must be submitted under the HRAP process for FHA condo approval. Funding of replacement reserves for capital expenditures and deferred maintenance must be in a separate account for at least 20% of the budget. No more than 10% of the units can be in arrears of 60 days or more. So no more than 10% of the people can be passed due on their condo dues. 60 days or more, so that's big. And then must provide 3 years of acceptable financial documents from the condo association when they apply. So if you can meet those guidelines, something that may not be approved for a FHA condo loan could be, so that's great news there. Now in the local news, the next first-time homebuyer seminar is coming up this Saturday. Next Saturday, November 19th. That's in Newark, Delaware, at the Christiana Hill Hotel from 10 a.m. to noon. You can register for that. If you have a call in the office, 302-703-0727 or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.